Hello students, so today we'll be taking up with illustration 27. Very first of all of you mark this illustration as very important illustration. It has a very important capital adjustment which we studied in the last lecture. The steps regarding that we studied in the last lecture. So that adjustment is going to be covered in that. Look at it. Pandit and Pandya are partners in a firm sharing profit and loss in the ratio of 2:1. So all of you underline 2:1, mark it as old ratio OR. The balance sheet of the firm as on 31/3/16 was as under. Very first of all, what all things from the balance sheet will we distribute between the partners? Capital reserve is a reserve, so put tick on that. That will get distributed between the partners in the old ratio 2:1. Mind well, workman's savings account is not a reserve. I repeat, workman's savings account is not a reserve. Okay, it is a liability. It is like provident fund, savings of the workers, which we are supposed to pay to the workers when they retire or leave the organization. So workman's savings account is not a reserve. It is a liability and it will continue to appear on the liability side. You don't have to distribute workman's savings account between the partners. Workman's profit sharing fund we are discussing since chapter 4, that workman's compensation fund is different and workman's profit sharing fund is different. Workman's profit sharing fund is also a liability and not a reserve, so it will not be distributed between the partners. No more reserves on the liability side. Asset side, goodwill will get distributed between the old partners in old ratio, and no more fictitious assets or accumulated loss. Now they admitted Patel as a new partner as on 1/4/16 on the following terms. We'll read the adjustments while we solve it. What is the final thing asked? Prepare necessary accounts and balance sheet of new firm. So all of you pause the video and make the formats of revaluation account, partners capital account with 3 columns, Pandit, Pandya and Patel. Pandit and Pandya old partners, Patel new partner. Then bank or cash account. Here we have cash, so you can make cash account itself. Okay, instead of bank account you can make cash account itself. And balance sheet as on 1/4/16 after admission. So all of you make this formats, pause the video and make it, and once you are done with the formats then you can play the video again. Okay, so I start with the solution. Now as we have been doing in earlier questions, very first we start with capital balances. All of you put tick on capitals. In partners capital account will record on credit side Pandit's capital 1,30,000, Pandya's capital 1,20,000. So in partners capital write down credit side by balance brought down Pandit 1,30,000 and Pandya 1,20,000. Okay, Pandit's 1,30,000 and Pandya 1,20,000. Which other balance do we record in the beginning? Cash balance. Put tick on cash. Cash is 80,000. So in cash account we'll write on the debit side. Cash always has a debit balance. So all of you write down in cash account on debit side to balance brought down 80,000. Okay, so 2 opening balances we have to record. We have already recorded that. Capital balance and cash balance. Capital balance 1,30,000 and 1,20,000 partners capital account credit side. Cash balance 80,000 in cash account on debit side. Now very first this capital reserve we will distribute between the old partners in old ratio. So capital reserve account debit, the account gets closed with 21,000 and 2 old partners, that is Pandit and Pandya's capital account, we will distribute the amount in the ratio of 2:1. So 21,000 into 2 by 3, 14,000, and 21,000 into 1 by 3, 7,000. Now capital reserve account debit means the account gets closed. Two partners capital account. So in partners capital, write down credit side by capital reserve 21,000 into 2 by 3. In Pandit's column 14,000 and 21,000 into 1 by 3. In Pandya's column 7,000. Okay. Other shortcut I told you, if you remember, left right, right left. In balance sheet capital reserve is on left side, so left right. In partners capital it will come on the right side, and between old partners in old ratio. Exactly same way with goodwill. You studied in the summary that very first for old goodwill the entry is old partners capital account debit to goodwill account. So in partners capital account, old partners capital account debit means we'll write on the debit side to goodwill account, and amount is 30,000. We'll distribute it in the old ratio 2:1. So 30,000 into 2 by 3, 20,000, and 30,000 into 1 by 3, 10,000. Okay, again left right, right left. In balance sheet goodwill is on the right side. So in partners capital account it will come on the opposite side, left side. In old partners in old ratio. Okay. So all the things from the balance sheet are taken. Now we take up with the adjustments. They admitted Patel as a new partner on 1/4/16 on the following terms. New profit and loss sharing ratio is to be kept at 3:5:1. Now new ratio is given, so very first we'll find sacrifice ratio, because without sacrifice ratio goodwill's distribution cannot be done. So all of you write down working note 1. First of all, write down the names of the partners, Pandit, Pandya and Patel. Okay, Pandit, Pandya and Patel. Now old ratio is 2:1. So 2 by 3 and 1 by 3. Patel is admitted, and the new ratio is given as 3:5:1. So new ratio 3:5:1. 3 by 9, 5 by 9, 1 by 9. Now sacrifice ratio is obtained as old ratio minus new ratio. So for Pandit, old ratio 2 by 3 minus new ratio 3 by 9. For Pandya, old ratio 1 by 3 minus new ratio 5 by 9. We don't have to find it for Patel, new partner. Sacrifice ratio we always find only for old partners, so here only for Pandit and Pandya. Now LCM is 9. 9 divided by 3, 3 into 2, 6. Minus 9 divided by 9, 1 into 3, 3. Same way here also LCM is 9. 9 divided by 3, 3 into 1, 3. Minus 9 divided by 9, 1 into 5, 5. So 6 minus 3 is 3 by 9, and 3 minus 5 is minus 2 by 9. Minus 2 by 9. Check it carefully everyone. This is a gain, not a sacrifice. If sacrifice comes negative, it means it is a gain, not a sacrifice. So only one partner is sacrificing, that is Pandit. Pandya doesn't sacrifice. After the admission of Patel, Pandya is also gaining 2 by 9. Now, after this, second adjustment. Patel brought 50,000 as his capital in cash. So cash comes in debit. What comes in cash account debit? Patel is the giver. Credit the giver to Patel's capital account. Now cash account debit. So in cash account we'll write on debit side to Patel's capital account 50,000 and to Patel's capital account. So partner's capital account on credit side by cash account in Patel's column 50,000. I repeat, cash account debit. So in cash account on debit side to Patel's capital account, opposite account 50,000 to Patel's capital. So in partner's capital account credit side by cash account in Patel's column 50,000. Okay, so second adjustment is done. Now third adjustment, interest on loan is outstanding for last year. All of you can see here 10% loan is given 50,000. So what would be 10% interest on loan of 50,000? 50,000 into 10%, 5,000. Now it is outstanding for last year, so it is our loss. We should be sad. Should we be happy or sad? Sad. So we studied this entry. Sad means revaluation account debit to outstanding interest on loan account. What amount? 50,000, 10%, 5,000. I repeat, we are sad because the interest on loan is outstanding. So it's a loss for the business, expense for the business. Revaluation account debit to outstanding interest on loan. What amount? 50,000, 10%, 5,000. Revaluation account debit. So in revaluation on debit side to outstanding interest on loan to outstanding interest on loan amount as we discussed 50,000, 10%, 5,000. And outstanding interest on loan will come on the liabilities side. Outstanding interest on loan $5,000. Okay, I repeat it again. Revaluation account debit. So in revaluation on debit side, opposite account to outstanding interest on loan 5,000. To outstanding interest on loan will come on the liabilities side. Outstanding interest on loan 5,000. Next adjustment. Personal expense of 8,000 of Pandya was debited to profit and loss account. That is a rectification to be done. Okay, personal expense but debited to profit and loss account 8,000. Let's make working note 2 for this. Now what should be the correct entry if personal expense of 8,000 is incurred? Whose personal expense is that? Pandya. So correct entry should be personal expense means Pandya's drawings account debit. Personal expense, so owner or partner Pandya is the receiver, debit the receiver. Pandya's drawings account debit 8,000. Cash goes out, credit what goes out to cash account 8,000. Now what is the wrong entry passed? Instead of drawings they say it was debited to the profit and loss account. Means instead of Pandya's drawings we have done profit and loss account debit 8,000 to cash account 8,000. This is the wrong entry passed. Okay, instead of Pandya's drawings we have debited P&L account. No mistake in cash is there. Now pass the correct entry, reverse the wrong entry. If you reverse this wrong entry, P&L to cash, it will become cash account debit to profit and loss account 8,000. Now cash, debit and credit gets cancelled. So what is the combined entry? Pandya's drawings account debit to P&L account. Okay, combined entry, rectification entry for this mistake is Pandya's drawings account debit 8,000 to profit and loss account 8,000. Now how will we pass the entry in admission of partner for the same thing? Pandya's drawings account debit means you'll write it in partner's capital account on debit side, and to profit and loss account means you'll write it in revaluation account on credit side. Means in this chapter the entry would become Pandya's capital account debit to revaluation. I repeat, from this chapter's point of view, the entry will become, instead of Pandya's drawings account debit, Pandya's capital account debit, instead of to profit and loss account, to revaluation account. So Pandya's capital account debit means in Pandya's capital we will write on debit side to revaluation account in Pandya's column 8,000. And to revaluation account means in revaluation account on credit side by Pandya's capital account 8,000. So I'll repeat it once again. It's an important entry. The whole question is very important. I told you in the beginning itself. Look at it again. Personal expense of 8,000 of Pandya was debited to profit and loss account. Very first of all, personal expense of Pandya. So correct entry should be Pandya's drawings account debit to cash account. We have wrongly debited to P&L account means instead of Pandya's drawings, we have done P&L account debit 8,000. No information is given about cash, means it is credited correctly only with 8,000. Now rule of rectification we have studied in 11th standard. Pass the correct entry and reverse the wrong entry. If you reverse the wrong entry, P&L to cash, it becomes cash to P&L. So cash account debit and credit gets cancelled and closed. The combined entry is Pandya's drawings account debit to profit and loss account. Now from admission of partners point of view, Pandya's drawings account debit means we will write Pandya's capital account on debit side, and to profit and loss account means we'll write in to revaluation account on credit side. So Pandya's capital account debit means in Pandya's capital, partner's capital debit side, opposite account to revaluation, Pandya's column 8,000. To revaluation means in revaluation on credit side by Pandya's capital account, opposite account 8,000. Okay. Still any confusion? Pause the video, rewind it and see it again. Fifth adjustment. Reconstruction expense of 12,000 is paid by Pandit. Now reconstruction expense paid by Pandit, first of all expense. So revaluation account debit for expense and paid by Pandit. So Pandit is the giver, credit the giver to Pandit's capital account. Okay, the journal entry, this is also a new adjustment. Reconstruction expense is an expense, debit all expenses and losses. So revaluation account debit for the same. Pandit is the giver, credit the giver to Pandit's capital account. Now revaluation account debit, so in revaluation account on debit side to Pandit's capital account, in bracket you can write reconstruction expense. Just for understanding, amount 12,000. Okay, amount you can see is 12,000 to Pandit's capital account. So in partner's capital account on credit side by revaluation account, in bracket reconstruction expense. In Pandit's column 12,000. Okay, I repeat it again. Reconstruction expense is an expense, debit all expenses and losses. So revaluation account debit, since it is paid by Pandit, Pandit is the giver, credit the giver to Pandit's capital account. Revaluation account debit, so in revaluation on debit side to Pandit's capital account 12,000. To Pandit's capital, so in partner's capital credit side by revaluation account in Pandit's column 12,000. Next, goodwill is valued at 2,70,000. Now goodwill 2,70,000. What is new partner Patel's share in 3:5:1? 1/9. So let's make the third working for goodwill. First of all, what will be the new partner, that is Patel's share in goodwill? Patel's share in goodwill will be equal to 2,70,000 is the value of goodwill into, okay, Patel's share is 1/9. Goodwill's value is 2,70,000. So 2,70,000 into 1/9. What does Patel's share in goodwill come to? 30,000. Now, is it given that Patel is bringing that amount in cash? Adjustment 6 is over. 7th adjustment has no mention about goodwill. Nothing is given means, of course, Patel does not bring in cash. I repeat, if Patel is bringing in cash, it would be given that Patel has brought his share of goodwill in cash. Here nothing is given, only goodwill's value is given, so it is implied that Patel, new partner, did not bring his share of goodwill in cash. Now what did we study? If new partner does not bring his share of goodwill in cash, then we will be writing new partner's capital account debit. Means if he does not bring in cash, we will take the share of goodwill from his capital. Patel does not bring 30,000 his share of goodwill in cash, so we will take this goodwill from Patel's capital. So Patel's capital account debit, okay, Patel's capital account debit new partner's capital account debit. Now further, to old partner's capital account in sacrifice ratio. Listen carefully. To old partner's capital account in sacrifice ratio. But here Pandya doesn't sacrifice, he gains. So we studied in the summary, if the partner is gaining, then even the gaining partner's capital account will get debited. Okay, I repeat, to old partner's capital account in sacrifice ratio. However, Pandya doesn't sacrifice, Pandya gains. So instead of credit, gain means you will do reverse. Even Pandya's capital account we will debit, and to only Pandit's capital account who is actually sacrificing. So this adjustment of goodwill is also very important in this question. Reason, one of the old partner doesn't sacrifice but gains. Since the old partner is gaining, we credit old partner's capital account in sacrifice ratio. But if the old partner is gaining, then instead of credit, we will debit the old partner in gain ratio. You can see in the summary of goodwill I made you write. In addition to new partner capital to old partner's capital, I made you write gaining partner's capital account also debit. Even in this portion, even if new partner brings his share of goodwill in cash, there also, if the old partner is not sacrificing but gaining, then gaining partner you will always debit. Okay. Patel's amount we already obtained this 30,000. Okay. Now regarding Pandya's capital, goodwill is 2,70,000 and Pandya's gain is 2/9. Here you can see 2/9 is the gain of Pandya. So even Pandya will give goodwill to Pandit. 2,70,000 into 2/9. 60,000. Why Pandya will give to Pandit? Because after the admission of Patel, Pandya is also gaining. So Pandya also has to give share of goodwill to Pandit, who is the only partner who is sacrificing. I repeat, after admission of Patel, normally both partners should sacrifice. But after new partner's admission, even Pandya is gaining. And only person sacrificing is Pandit for the admission of new partner. So Patel and Pandya, both the partners will give goodwill to Pandit. Okay. How will you find Pandya's capital? Because he is not sacrificing but gaining. Total goodwill 2,70,000 into Pandya's gain 2 by 9. So Pandya's capital account will be debited with 60,000. Any confusion then? You all watch the goodwills accounting part lecture in this chapter again. You'll find the reference in that lecture that gaining partner is also to be debited. And Pandit's amount, okay, Pandit's sacrifices 3 by 9. So 2,70,000 value of goodwill into Pandit's sacrifice 3 by 9. So what he must get as goodwill from the other two partners is 90,000. So only sacrificing partner Pandit will get 90,000, out of which 30,000 new partner will give and 60,000 even old partner Pandya will give, because he also gains after the admission of Patel. Okay. So once again everyone remember, normally if the new partner does not bring his share of goodwill in cash, the entry is new partner's capital account debit to old partner's capital account in sacrifice ratio. But if any of the old partner is not sacrificing, rather gaining, then instead of crediting, that old partner which is gaining will also get debited. Here Pandya is not sacrificing but gaining, so even Pandya's capital account will get debited with the gain ratio. So goodwill 2,70,000 into Pandya's share 2 by 9 60,000. Patel's share we already obtained 30,000, and Pandit is the only partner who is sacrificing, will get goodwill 3 by 9, so 2,70,000 into 3 by 9 90,000. Okay, still I repeat, if any confusion in this entry, watch the video lecture of goodwill again. Now Patel and Pandya's capital account debit. Okay, one more correction over here. New partner Patel, we will not debit capital but we will debit current account. Now understand the reason why. Make this correction. To understand this, first let us read the next adjustment. Adjustment number 7. Capital of Pandit and Pandya, that is old partners, in the new firm should be kept in the new profit and loss ratio by taking Patel's capital as base. Patel is the new partner. His capital 50,000 is to be taken as the base, and we have to adjust the capital of old partners Pandit and Pandya accordingly. Now if you debit Patel's capital account here, then Patel's capital 50,000 will get reduced by 30,000. So the base will change. Old partners have decided that they will maintain their capital on the basis of the capital brought by the new partner Patel, which is 50,000. If you debit Patel's capital account with 30,000, then his capital of 50,000 will decrease by 30,000 and become 20,000, as a result of which the base will change. Patel's capital 50,000 is taken as the base for deciding the capital of Pandit and Pandya, so we cannot change his capital, we cannot change the base. That's why instead of Patel's current account, capital account, we debit Patel's current account. I repeat it again. Look at adjustment 7. Capital of old partners Pandit and Pandya in the new firm should be kept in new profit and loss ratio, but by taking Patel's capital as base. What is Patel's capital? 50,000. This is to be taken as base. So we cannot change his capital, because if his capital will change, entire base will change, everyone's amount will change. We have to keep his capital intact 50,000 only. So if his capital is to be kept intact 50,000 only because it is taken as base, then he does not bring his share of goodwill in cash. We cannot change his capital also. Then where from will we take this 30,000? I repeat, Patel does not bring his share of goodwill in cash. and we have to take his capital as base, means we cannot change his capital also. Then where from will we take this 30,000? We'll take it from his current account. So here instead of Patel's capital account, because of that last adjustment, we debit Patel's current account. Now effects. Patel's current account debit 30,000, straight away write it on the asset side. Debit means write it on the asset side. Patel's current account 30,000. I repeat, debit balances will come on the asset side. So Patel's current account debit, we are not making partner's current account in this question. So Patel's current account debit, straight away write it on the asset side 30,000. Pandya's capital account debit, so in Pandya's capital you all write it on the debit side. Pandya's capital on debit side, opposite account to Pandit's capital account. In Pandya's column 60,000. I repeat, Pandya's capital account debit 60,000. So in Pandya's capital account debit side, in Pandya's column write 60,000. Name of opposite account to Pandit's capital account. To Pandit's capital, so in Pandit's capital will write on credit side both the opposite accounts by Patel's current account. And amount will come in Pandit's column who is sacrificing 30,000. And by Pandya's capital account. By Pandya's capital account in Pandit's column 60,000. I explain the effects again. Patel's current account debit 30,000, straight away write it on the asset side. Patel's current account 30,000. Pandya's capital account debit 60,000. So in Pandya's column on debit side amount will come 60,000. Name of opposite account to Pandit's capital account. To Pandit's capital, so Pandit's capital it will come on credit side. Both the opposite accounts by Patel's current account 30,000 and by Pandya's capital account 60,000. Okay. By Patel's current account 30,000, by Pandya's capital account 60,000 in the column of Pandit. So adjustment 6 is also done. Now adjustment 7. Capital of Pandit and Pandya in the new firm should be kept in new profit and loss ratio. What is that new ratio? 3:5:1. So in this ratio we have to keep the capital of the partners by taking Patel's capital as base. And underline, for this purpose necessary adjustments are to be made in their current account. We always do this adjustment after revaluation accounts balancing. So first let us do revaluation accounts balancing, then we will take up with this adjustment. Okay. Unticked items, let us record it before that. Capital is recorded, capital reserve is recorded. Workers savings account 10,000, write down on the liability side as it is. Workers savings account 10,000. Next liability unticked, workers profit sharing fund 12,000. Write down workers profit sharing fund 12,000. Workers profit sharing fund 12,000. Which other liability is unticked? 10% loan 50,000. That is also remaining to be recorded. Only outstanding interest was recorded. Loan is remaining to be recorded. So write down 10% loan 50,000. After 10% loan, creditors 57,000. All these items were unticked. We need to record them first. So creditors 57,000. Liability side all are recorded now. Asset side only goodwill is ticked. So building 2 lakhs as it is. building 2 lakhs as it is. Next, furniture 40,000 as it is. Furniture 40,000. After furniture, stock 26,000 as it is. Stock 26,000. After stock, debtors 24,000 as it is. Debtors 24,000. After debtors, cash we have already recorded. So all unticked items are recorded. Now first we'll do revaluations, balancing, then we'll take up with adjustment 7. In revaluation, debit side is more. So 12,000 plus 5,000, 17,000. 17,000 minus 8,000, balance is 9,000 by partners capital account, and we will distribute it between old partners in old ratio. So between Pandit and Pandya, in old ratio 2:1. So 9,000 into 2 by 3, 6,000. 9,000 into 1 by 3, 3,000. Opposite side in partners capital account to revaluation account. In Pandit's column 6,000, Pandya's column 3,000. Now revaluations balancing is done, so we take up with adjustment 7. Capital of Pandit and Pandya in the new firm should be kept in the new ratio, which is 3:5:1, by taking Patel's capital as the base. Now understand what does it mean. Working note 4. What is Patel's capital which is to be taken as base? 50,000. What is Patel's share in the new profits and loss sharing ratio? 5:3:1 means 1 by 9. Okay, 5:3:1 means what is Patel's share? 1 by 9. Now if you refer to the steps I made you write in the last lecture, if Patel's capital is 50,000, Patel's share is 1 by 9, then what would be the total capital of the firm? We discussed total capital of new firm. If you take Patel's capital as the base, which is 50,000, it must be 50,000 into reciprocal of his share 9 by 1. That comes to 4,50,000. If you take Patel's capital as the base, then Patel's capital 50,000, his share 1 by 9. Then based on Patel's capital of 50,000 and his share 1 by 9, what should be the total capital of the entire firm? 50,000 into 9 by 1, 4,50,000. This capital of the firm, taking Patel's capital as a base, should be maintained between Pandit, Pandya and Patel in the new profit sharing ratio, which is 3:5:1. Okay, it is given capital of Pandit and Pandya in the new firm should be kept in the new ratio, which is 3:5:1. So 3 by 9, 5 by 9, 1 by 9 means 4,50,000 into 3 by 9. So 1,50,000, 4,50,000 into 5 by 9, 2,50,000, and 4,50,000 into 1 by 9. Of course, Patel is 50,000. We already know his capital is only taken as the base. Now what steps did I make you write if you refer to the yesterday's lecture? These amounts which are obtained on the basis of Patel's capital as a base. If Patel's capital is 50,000, then as per the new ratio 3:5:1, Pandit's capital should be 1,50,000, Pandya's capital should be 2,50,000. These amounts you write in partner's capital account on debit side as closing balance. All these amounts. As per the Patel's capital, Pandit and Pandya will adjust their capital. How they will adjust their capital? If Patel is bringing 50,000 for 1/9 share, then for 3/9 share, Pandit's capital must be 1,50,000, and for 5/9 share, Pandya's capital must be 2,50,000. So these capitals, what they should be, we will write in partner's capital account as debit side closing balance. So all of you first write down this closing balance in partner's capital account debit side to balance carried down in bracket working note 4 in bracket working note 4. What amounts? Pandit 1,50,000, Pandya 2,50,000, and Patel new partner of course 50,000. So taking new partner's capital as base 50,000, now in the new firm Pandit's capital should become 1,50,000, and now in the new firm Pandya's capital should become 2,50,000. Now what do they say further? For this purpose, necessary adjustments are to be made in their current account. So adjustment is to be made in current account means now in partner's capital account, wherever debit or credit side, whatever balance remains, we will adjust that and transfer it to current account. I repeat, for this purpose, necessary adjustments are to be made in their current account. Here you can have cash account also, bank account also. In this question, they have mentioned that necessary adjustment is to be made in their current account. So now whatever balance remains in partner's capital account, whether debit side or credit side, transfer it to their respective current account. Now if you see Pandit, then debit side 150 plus 60 plus 20 plus 6 is 176. And credit side 130 and 60 itself makes it 190. So credit side total is more. Do it one by one for every partner. First we do it for Pandit. Credit side is more. So 130, 190, 220 plus 26, 246. 2,46,000 is the total of Pandit on credit side. Write that on both the sides, 2,46,000. I repeat, 130, 190, 220, 30, 40, 46. Now from 2,46,000 you subtract all these amounts, 20,000, 6,000 as well as 1,50,000. So what balance we have to transfer to current account? 246 minus 150, 170, 176. 246 minus 1,76,000 is simply 70,000. This we will transfer to partner's current account. In bracket balancing figure. As per the last adjustment, we have to make necessary adjustment to current account. So whatever balance is remaining in partner's capital account, transfer it to partner's current account. For Pandit, credit side total was more. So debit side 70,000 remaining we transfer to partner's current account. Now we see for Pandya. Credit is 127, debit itself is 250 single amount. So here debit looks more. First do debit side total. 2,50,000, 3,10,000, 328, 331. 3,31,000 is debit side total of Pandya. I repeat, 250 plus 3, 253 plus 6, 3,13,000 plus 8, 3,21,000 plus 10, 3,31,000. Now 3,31,000 minus credit side amounts, if we subtract 1,27,000. What will remain if you subtract 1,27,000? 2,04,000. That we will transfer to by Pandya's current account. Okay, whatever balance remains in partner's capital account as per the last adjustment, written in bracket balancing figure, we have to adjust and transfer to partner's current account, and do it for every partner one by one, because any partner credit side total can be more and any partner debit side total can be more. Here Pandya debit side total is more, so 2,31,000 plus this, 3,31,000 minus 1,27,000, 2,04,000 we transfer to Pandya's current account. And Patel, both the sides are 50,000 only. He has no balance because his capital himself itself was taken as a base, so he will not have any balancing figure. Okay, and moreover that goodwill also we did not take from his capital, we took that goodwill from his current account for this very reason, because his capital was to be taken as base. So Patel both the sides is 50,000 only, because his capital is the base, so no further balance will remain. Now this capitals 150, 250 and 50 will write on the liabilities side. Capitals Pandit 1,50,000, Pandya 2,50,000 and Patel 50,000. So total capital 4,50,000 we even obtained in working note 4, that total capital of firm should be 4,50,000. Now this partner's current account, this 70,000 is a credit balance, credit side total was more. So 70,000 you write on liabilities side, Patel's current account. Okay, Patel's current account, credit side was more, so it's a credit balance, you write it on liabilities side 70,000. And this balance, Pandya's current account 2,04,000, debit side was more, so debit balance you write on asset side, Pandya's current account 2,04,000. Okay, Pandya's current account 2,04,000. Now cash accounts balancing 80,000 plus 50,000, 1,30,000. Okay, 80,000 plus 50,000, 1,30,000 by balance carried down. Asset side cash 1,30,000. And now balance sheet must tally. So 4,50,000 plus 70, 520 plus 10, 530 plus 50, 580 plus 5, 585 plus 12, 597 plus 57, 6,54,000. And asset side 30 plus 2 lakhs, 2,30,000 plus 40, 2,70,000 plus 50, 320 plus 2,04,524 plus 130, 6,54,000. So the balance sheet gets tallied. Now based on this, all of you must be able to try exercise question on your own. Okay, it's mentioned in the schedule also, but based on this exercise question 16, everyone must be able to try on your own. Okay, it is exactly similar one. So that will be all in this lecture. Bye everyone, take care.